Hey there, and thanks for watching. Over the next few minutes, I'll be walking you through my retail development model. Now, if you're already familiar with our office or industrial development model, you can really stop right now. This model is largely built on those two models. 95% of the inputs are the same, and you're going to already know how to use this model if you've used either of those models. If you're new to the model, this video is for you. So over the next few minutes, I'm going to talk through the tabs or the worksheets that are used in this model and how to get the most of it to model your single tenant, multi-tenant retail development opportunity. So the first place you come when you download the model is the Versions tab. This is where you'll see any of the changes that have been made since this video was released. You'll find that in the change log here to the left. You'll also see the feature requests that we plan to add to the model at some point in the future. And I should say, if you have a feature request that you'd like added to the model, just go ahead and add a comment below or shoot us a message. We'll add it to the feature request list, and at such point that I get a moment, I'll go ahead and add that feature. Beyond that, on this tab, the Versions tab, you'll see just some helpful links to things like this model's page on the internet. That's where you'll be able to download a fresh version of the model. You'll also see our best practices guide, and then you can browse our entire library. I think we're up to 70-something real estate financial models available to download for free. So that's the Versions tab. Next, you're going to see the Summary tab. This is where a summary of the returns, the outputs from your analysis on the Underwriting tab. So I'll come back to the Summary tab at the end of our video here. But now we get to the bulk of your underwriting. Now, there's a methodology that I follow when I build models, which is I put the bulk of my inputs onto one worksheet. And really, all of the inputs that matter come or are entered on the Underwriting tab. If you're unfamiliar with our models, blue font cells are input cells. You need to change every blue font cell. Black font cells are output cells. That's calculations and outputs. Occasionally, you'll run across a green font cell. That's just a link to a calculation done on another worksheet. And because we don't use a lot of worksheets in our models, or at least I personally don't, you won't see a lot of green in my models. Now, to orient you to the Underwriting tab, what I've done is laid out all of the inputs here in columns B through I, and I've broken this out into sections. And you can either quickly navigate to a section by using these buttons above, or you can scroll up and down. So for instance, the first section is the investment description section. You click there, but I can quickly go, say, to the return section, and that will scroll all the way down to the returns where I see the return outputs from the analysis in our investment cash flow, operating cash flow, and reversion cash flow sections of the Underwriting tab. So we come back up to description, and this is really where you start, and you're just entering descriptive elements of the investment. Where is it at? When do you expect to begin development? Your analysis begin date? What's your retail building type? Neighborhood, center, we have a bunch of single tenant types: banks, auto repair, grocery store, gas station, and then more of your multi-tenant. So neighborhood center, community center, regional mall, super regional mall, fashion center, so forth, power centers, and the like. We also have here the option to toggle between speculative and build-to-suit. Again, more informative. If you're doing a build-to-suit for, say, a gas station tenant, single tenant, that would be build-to-suit. Maybe you're doing a build-to-suit for a grocery store, but you have some inline. You might call it either speculative or build-to-suit. You also have the ability below, you'll see in a minute, to tag each tenant as to whether they're spec or build-to-suit. Outside of that, you're going to enter things like land area, gross building square footage, or you can toggle to meters if that is your preference. But down below, your net rentable, which in this case, I assume my gross buildable and my net rentable square footage is the same, but you'll enter a square footage or a rentable area for each of your tenants, and that flows up to this number here. Enter the number of buildings, number of, say, surface parking versus structured parking spaces, Many retails surface, but some of the more regional malls or urban centers will have structured parking. And that really is your investment description section. Then we flow to the investment period cash flows. This is your project budget as well as your sources of capital to cover those project budget, those uses of capital. So we have things like land costs, hard costs, soft costs that flow up to a total project cost before financing. And then we have some carry costs. This assumes a construction loan. You have the ability to add a second layer, a second tranche of construction debt, and you do that down here under your sources. So you might have a construction loan. You might also have some mezz debt above that. And that together with your equity gets your total sources, and your total sources will match your total uses of capital. Now, we also have the ability here to add in permanent debt. So if you were to click the permanent debt toggle button here, you'll see that there is some permanent debt that takes out your construction financing, and then you would hold long term, and that would be a build-to-core sort of situation, or you go no permanent debt. And the assumption is at the end of your construction and lease up, when you hit stabilization, that you'll sell in a merchant build sort of strategy. So that's the investment cash flow section. A lot of the inputs I think are pretty self-explanatory, but I'll just go through a couple of them quickly. So the budget, again, is within this section. And then out to the right, you have your cash flows. And those cash flows are based on some assumptions here. So for instance, our construction costs are assumed to start in month 1, end in month 18, and those are modeled out on an S-curve. You also have the option to model on a straight line, a steady growth, or a steady decline, or you could detail it. You might have choppy cash flows, and details are you just simply add the cash flow out to the right. So here I'm going to assume an S-curve. This is my budget amount, and so what happens is this out to the right will automatically forecast 15,180,000 starting month 1, ending month 18 in an S-curve or a bell-shaped fashion. So you'll see that cash flow starts small, grows big to some period in the middle, and then tapers off at the end in a bell curve sort of way. And you can do that for each of your line items. You can add items, you can delete items, right? Add a land cost, delete a land cost, and so forth. So then we move to the operating period cash flows. This is where you're going to model things like your rent roll, your operating expenses. So the first input is going to be your operation begin month. This is when you expect really you have some space or maybe all of the space ready to occupy, your operation begin month. The other thing out here to the right is this is your property tax percentage. So let's imagine that your stabilized property tax is $1 million. In many jurisdictions, property taxes lag the reality at the property level, and so we have this ability to say, okay, in year 1 of operation, let's say it's our stabilized property tax is $1 million. We're actually only going to owe 25% of that. That's then maybe year 2, 75%, year 3, 100%, year 4, 100%. Every jurisdiction is different. These are inputs that are up to you. Yours may be more like that, or perhaps it's something like that. Nevertheless, you make those updates and those flow out to the right under your property tax. Now you'll notice as soon as we start making changes to inputs, that has an effect on the amount of interest that is going to be due under the construction debt. And because that interest accrues and then interest is paid on top of interest, it becomes a circular logic. And that circular logic requires either turning on Excel's iterative calc feature, which if you're familiar with our models, we never do. And there's a variety of reasons for that. And so to solve for the iterative piece, either you can do some manual iteration, which is unnecessary, or we've built in a macro that will know when an update or a calculation, an iteration needs to happen, and this red click to recalculate button appears. Now, if you're interested to know how that works, you probably may have come across, if you've looked at any of our other models, this cell here, I-59, is a black font cell. You'd expect a formula in it, but if you look up here, it's not. It's some number. You'll notice it's a number with a lot of decimal places after that. This is the iteration, and so what this green button does essentially is it says, okay, our input for loan to cost and our construction debt's 65%. Right now, the construction is 65.1% of our sources. Therefore, it's out of whack, and we need to change this cell until this value equals this value. And so I just build a macro that automatically does it. You could technically, it would take a long time, change this cell until such point in time, oops, I'm going the wrong direction, until such time that this equals this, or you simply click that. And that automatically changes that value until this cell equals that. It's an iterative thing. Okay, so when I changed some of my property tax lease-up assumptions, what it did is it meant that there was a bit more, I had to pay more in property taxes. That meant that there was a bit more interest that was due, and that interest accrued, and then interest was charged on top of interest, and it put the percent of sources right here out of whack with our loan to cost and needed to be updated. Okay, so those are, call it our top line assumptions under our operating period cash flow section. Next, we have inputs for rent roll. Here again, you can add or delete tenants. So I could add a tenant here, and let's say it's another out parcel. I'm just going to label this out parcel 3, and let's say it's an auto store. So auto store number 99, and let's say it's 6,500 square feet here. And this tenant down here, it's the auto store. I'm going to call this, I have a signed lease from them, and they're going to start their lease same month as operation began, 19. And their rent start, though, is going to be 6 months later. All right, and the thinking is, okay, I'm going to give them 6 months of free rent in order to induce them to sign this lease, this long-term lease. Maybe it's 180 months. There's a 2% annual rent growth, and they pay, let's say, $45 a square foot. Let's make it 40. It doesn't really matter. So I've added a tenant now to our rent roll, and you'll see up at the top under our description, now our net rentable area has gone up to 98,500. Our building coverage, since we didn't change the size of the land, is now 30% of our total land area. And so again, you tweak around your rent roll, your inputs across each, and that then impacts, you'll notice here, even I need to now recalculate. I click to recalculate. Now, there's a second half to our rent roll, and that is, call it recovery. So we have some status. We have a tenant type. So I called that an out parcel, right? But then we have a recovery start. When we say recovery, that means the landlord is paying some operating expenses. And the question is, how much of those operating expenses then can be recovered from the tenants, or will the tenants reimburse the landlord for? And in this case, we're assuming all the tenants pay for 100% of, or the landlord can recover 100% of operating expenses from the tenants in this pro rata share. Now, occasionally you'll see this orange font. Orange font means a optional input. So you don't have to change these. I have a formula in here that estimates what the value would be, but in some cases it becomes necessary to change these values, in which case you would. Where, say, a tenant's pro rata share of total net rentable area might be 66%, but under the lease, the tenant's only obligated to reimburse for, say, 50% of total operating expenses. In that case, you change this to 50, and in the end, we're only recovering 84% of our total operating expenses. Same here. So this 100% basically means these are all triple net leases. If we went to 0%, these would be gross leases, right? We can't recover any of the operating expenses, and therefore the operating expenses are embedded into our base rent. But here we're going to assume they're triple net, as is most commonly the case in the United States these days. So that's our, call it, rent and recovery income. That gets us to a potential gross income. We then pair that back by some general vacancy and credit loss. In this case, I'm going to say 10%. And we get to an effective gross revenue. Then we've got some operating expense line items, really four for now. Common area maintenance, management fee, insurance, and property taxes. And then we have some expense growth for each of those line items. And then an amount out here to the right for common area maintenance, $10 a foot, growing at 2% a year. These expenses are 25% fixed. What that means is when you're 0% occupied, 25% of this $985,000 is still due. And that makes sense, right? When there are certain expenses that whether you're 0% occupied or 100% occupied, you have, like utilities. But in the case of common area, the more occupied you are, the higher that expense line item is. You have more traffic, you're using more utilities, and all of that means that expense number grows. And so it's partially variable, 75% variable, 25% fixed. Management fee is a percent of effective gross revenue, in this case 3%. And then insurance is 100% fixed, right? Your insurance is what it is, whether you're 0% occupied or 100% occupied. In this case, we're assuming $2.50 a foot is our insurance cost expense. And then property tax is some number. Now, there's a value out here to the right, mill rate. This is a concept in the United States, but I think it's common in other countries. It may be slightly different, but the idea is this is your property tax is a percentage of your total value. And again, in the U.S. called a mill rate or a millage rate. And so that helps you track. And in a lot of locales, your property taxes is some set percentage of total value. And so you can use that to size this. So $10 would get us to $350, which is very high. $250 gets us down to, let's do $275. Yeah, $3 a foot is about 1% mill rate. And I'll just leave that for now. So that's our operating expenses. We take EGR, effective gross revenue. We subtract total operating expenses. That gets us our net operating income. From that, we arrive at some stabilized value, which you'll see down in the reversion cash flow section. But the last piece is some assumptions around capital expenditures, right? So this model does not include the complexity around second generation, third generation leases, but it does include a concept which is a leasing reserve. So while you don't have any rollover in this model, you do have the ability to model the average cost of what that rollover would be out in the future. And this is most helpful if you're going to be doing a build to core analysis where you use permanent debt to take out your construction debt and hold this, say, for 10 years. You can assume some market leasing assumptions. And then what's going to happen is as we go out here to the right, and if you just follow this leasing cost reserve number, here as of the first stabilized month, it begins charging a leasing cost reserve. Think of that as an estimate of the total cost for keeping the building leased through a long-term hold period. And so while the expense doesn't actually happen in that month, you reserve that expense for some future point. And so it assumes $493,000 per year of leasing costs. Again, most of that will happen out in the future, but you're reserving it for those future expenses. And there's also a CapEx reserve, a similar concept where you're going to have lease repair, parking lot repair out in the future. It may or may not be reimbursed by the tenant, and so we can include some amount per year that's held in reserve and used out in the future. So we take our net operating income, we subtract out our capital expenditures. That gets us to a cash flow from operation. And again, the inputs you see in here are just dummy placeholder inputs. You're going to edit your own here. I think we're at like 42% of NOI. That's excessive for capital expenditures. And so you'd likely come in here and pare this back. Nevertheless, we get to cash flow from operations, and that's the end of our operating cash flow section in the case of a merchant build. Now, if we do a build to core where we have permanent debt, now you're going to see a debt service line and a cash flow after financing. So In a merchant build scenario, there's no debt service. Interest accrues to the budget. Some of that or some operating income might be used to cover interest, but that's calculated in a different section. And so in the operating cash flow section, we add in a debt service line for permanent debt. So for instance, in this case, if we were to add permanent debt, you get cash flow from operation of $1 million, NOI of $1.7 million, debt service of $572. I believe we're using all IO. Yeah, interest only. You could do amortizing. So let's do amortizing. Let's assume a 5% rate. Let's assume the loan funds as of stabilization, month 31. And let's assume a loan amount that just pays off the construction debt. There's no cash out in our refinance. And we'll amortize this over 30 years with a 1% rate. What you get is now a debt service payment of $922. Let's pare back our CapEx a bit. It's excessive. So let's do tenant improvements that are quite a bit lower. Let's assume a longer lease term. Okay, now we're getting roughly 30% of NOI, which is still high. Let's take our downtime to 3 and 0. Okay, 26%. And let's assume a 80% renewal rate. And actually, our average rent is going to be a little high. So let's do 16 because some of that is anchor space. It's lower. All right, so now we're 23%. Let's go to $1.50, 17. Let's go $2. Yeah, about 20%. Which long term on a shopping center is still conservative, but we'll keep it there. So we got 1.3, almost 1.4 million of cash flow from operations. Debt service of 919 leaves us with cash flow after financing of 464. So again, that's the operating cash flow section. Finally, we have the reversion cash flow section. This is where we're analyzing our sale. We're analyzing our stabilized value. And so our inputs are things like, okay, what's the market cap rate today? That's as of the beginning of this analysis, the analysis begin date. What is the cap rate at sale? So currently, this is a build to core. It's a 120-month hold period to the sale month. And so out in the future, I'm going to assume that we have 50 basis points of cap rate growth over 10 years. Our building becomes somewhat obsolete. It's no longer the shiny new asset, and there's some expectation around, or there's a higher risk of rates climbing over the next 10 years than compressing over the next 10 years. And so we'll just assume a terminal cap rate that's 50 basis points above our cap rate in our market cap rate today. Some selling costs out in the future, let's say 2%. And again, sale month of 120. And then this automatically pulls in the year following 120, or months 120 through 131 is what pulls in here. And you'll notice they're blue font cells, and that's because your reversion pro forma, or in other words, the income and expenses that the next buyer assumes, may not exactly mirror or match your month 120 through 131. And so those are blue font cells. You make edits to such degree that you think is necessary. You'll notice things like it tells us the mill rate stabilizes as 1%, but it assumes a mill rate of 1.22 at sale. And so we might pare that back to 325, something like that. Again, depends on your jurisdiction, but you make some edits to your reversion pro forma. You get your reversion NOI, $2,073,000. Divide that by the cap rate at reversion, or terminal cap rate, and you get a value at sale of $32 million. That compares to a stabilized value of $28.5 million. That's the value in the stabilized month with or the first stabilized year, month 31 through 42, $28.5 million. And you compare that $28.5 million to what? Your project budget, which is almost $22 million. And that's the value pop you get from the development, roughly $6 million, which when we go to the returns, we can see a few metrics that help us gauge whether that's sufficient or not. The first metric in development that I look at is my yield on cost. That's my stabilized NOI without any growth, divided by my total project cost. And that's 8%. And I compare that to the market cap rate at stabilization. Actually, this is with growth. So 802 is with growth divided by my market cap rate at stabilization. That's 613, and I just use a straight line from 6 to 6.5. And that gets us the difference between those two we call our development spread, in this case 189 basis points. And in my experience, that's sufficient spread to justify the risk in a development like this. Every market will be a little different. So that's one metric I'm looking at. I have that similar metric at sale, which matters less 10 years out in the future. Then I have a net unlevered IRR and levered IRR, as well as unlevered equity multiple and levered equity multiple. Then I have some net profit number. Now, these are based on the sale month. So if I go back to the merchant, so let's turn off our permanent debt. I come back down here, and then the other thing, let's just hold the cap rate flat. So the cap rate at stabilization is the same as today. And come back down here. There we go. So now we're talking 200 basis points of spread. It's 802 yield on cost to a 6 market cap rate, 202 basis points. And then our IRR on that, what was the hold period? 43 months. IRR is 15 unlevered, 20 levered. It's a 141 multiple levered, $8 million of net profit. And so that's our return section. We also have partnership level cash flows within the return section. So what this is going to do is going to pull in our project level cash flows above, and it's going to divide them up between the partners. And you have the option to do just a single promote. That's where you have call it a developer, our GP, and an LP. And the developer, by the way, may have GP capital and may have a separate entity that's collecting fees and nevertheless, a single promote, you just really have one partnership, GP and the LP, with possibly a developer in the mix. A double promote is where at the GP level, there's some splitting of cash flows via promote structure. And you click this double promote button, and that gives you the ability to do 2 waterfalls, one for the GP and LP, and then one for the co-GP structure. And that's, again, our partnership level cash flows. If you're unfamiliar with how those work, it's enter some contribution share for your GP, and it'll automatically calculate for your LP. So let's say that the GP is going to contribute 5% of the required equity. That's the GP's contribution. LP contributes 95% of capital. And then we have some hurdles. So at the preferred return level, let's say that it's a 10% 10% preferred return hurdle, or in other words, cash flow is split 95-5 until the LP has earned a 10% annual IRR. Above that, then there's some promote. So the GP gets, let's say, 20% promote until the LP has received a 15% IRR. And this is the distribution breakdown, right? 20% promote to the GP. The remaining 80% is owned 95-5, such that 24% in this tier of total cash flow is distributed to the GP, 76% to the LP. And then you have up to 2 more tiers that you can model from there. And then finally, there's a sensitivity analysis section where you can sensitize different inputs, vacancy, exit cap rate, expense growth, income growth, and see how that impacts your development spread and your levered equity multiple. So that is the underwriting tab. All of these inputs then flow such that you get outputs on the summary tab. And I've noticed a couple things I need to fix, but and you'll see that fixed when you download the latest version of the model. But again, these are outputs. You'll notice they're black or grayish font cells. This is a printable worksheet. You can see that with the dark blue line around that. It's meant to be printed. Just simply go File and Print, and it will print to one page in a relatively nice form. The only inputs here are you can add strengths and weaknesses that you see in the deal. You can drop in over here to the right an image or a map just to give kind of visual appeal to your summary tab. then we've got key assumptions and return metrics, our sources and uses. I can widen that a little bit, and you can see construction loan payoff and your equity proceeds from sale. And then we've got some graphs, things like total project cost by month visualized out, your equity and debt outflows. Equity goes in first, debt goes second. Net operating income visualized out. And then over here, call your equity IRR by partner, LP versus GP. We don't have a third partner in this case. Equity multiple by partner, IRR. And then here's our development spread, stabilized versus sale. And finally, if you click this show button, this is going to show the annual cash flow report. Click that, and then a new worksheet appears at the bottom, annual cash flow. And this is just going to visualize your summary, a summary of the cash flows by year in, say, your investment cash flows, your operating cash flows, and your reversion cash flows to some net unlevered and levered line. Now, I don't calculate annual returns because we have monthly cash flows and those are going to be more accurate. But this gives you, and again, a printable report that shows your annual cash flows. And so that's it. That's the retail development model. If you have any features that you'd like added, or if you notice a bug, either leave a comment in the YouTube video or shoot us an email. Happy to do that. Please subscribe if you find value in this content. You can either subscribe to us on YouTube or follow us on LinkedIn. And of course, you can always find us at adventuresinCRE.com. So again, thanks for your time, and look forward to the next one.